Have you ever wondered how some people seem to effortlessly build wealth while others struggle to make ends meet? What if you were told that you could start building your own wealth from scratch, no matter where you are right now? Welcome to our channel. In today's video, we're diving into a step-by-step plan on how to build wealth from scratch. Whether you're just starting out or looking to improve your financial habits, this guide is packed with practical tips and strategies to help you achieve financial independence. So let's get started. Step number 1. Make money. The first step in building wealth is earning money. While this might seem obvious, it's a crucial foundation you can't save or invest without having an income. Think about those charts you've seen that show how a small amount of money, regularly saved and allowed to compound over time, can grow into a substantial sum. But how do you get the money to save in the first place? There are two primary ways to earn money: through earned income or passive income. Earned income comes from your job or business, where you actively work to make money. On the other hand, passive income comes from investments or businesses that generate revenue with minimal ongoing effort. This could include rental income, dividends from stocks, or royalties from creative work. Both types of income play a vital role in building and maintaining wealth. It's important to focus on a few key strategies to maximize your earning potential. First, do what you enjoy. When you're passionate about your work, you're likely to perform better and build a long-lasting career. In fact, one study found that more than 9 out of 10 workers would trade a percentage of their lifetime earnings for greater meaning at work. Second, leverage your strengths. Identify what you're good at and find ways to monetize those talents. Finally, research your options. Consider career paths that align with your interests and skills. Step number 2. Envision your goals and develop a plan. Clear financial goals are essential for building wealth. Whether you aim to retire early, buy a home, or fund your children's education, setting specific, measurable, and time-bound goals will guide your financial plan effectively. Start by defining your goals. Understand what you want to achieve and calculate the costs involved. For example, you might aim to save for retirement or purchase a property. Next, create a plan. Develop a strategy that includes budgeting, boosting your income, and investing in assets that will appreciate over time. Finally, review your plan regularly. Your financial plan should be flexible, allowing you to track your progress and make necessary adjustments to stay on course. Step number 3. Save money. Simply making money won't lead to wealth if you end up spending it all. It's crucial to manage your finances wisely, especially when it comes to saving. If you don't have enough money to cover your bills or handle emergencies, prioritizing savings becomes essential. Many financial experts recommend setting aside 3 to 6 months' worth of income to create a safety net for such situations. This approach not only ensures you're prepared for unexpected expenses, but also forms a solid foundation for building long-term wealth. To set more money aside for building wealth, consider taking a few strategic steps. First, track your spending for at least a month. You can use a budgeting app, a spreadsheet, or even a small pocket-sized notebook to record every expense, no matter how small. Many people are surprised to see where all their money goes once they start tracking it. Next, cut unnecessary expenses by categorizing your spending into needs, like housing and insurance, and wants, such as dining out and entertainment. Focus on trimming the latter to free up more money. Finally, set clear savings goals. Determine how much you can afford to save each month and automate your savings through direct transfers to your account. To secure your financial future, start by contributing to your retirement. Financial planners often recommend contributing at least enough to get your employer's full matching contribution, as it's essentially free money. Also, maximize the payoff of your savings by shopping for high-yield savings accounts, which offer significantly higher interest rates and lower fees compared to standard savings accounts. For those who can afford to lock up their money for a set period, certificates of deposit can also be a good savings option. However, remember that you can only cut costs so much. If you've already minimized your expenses, consider exploring ways to increase your income to further boost your savings and investments. Number 4, invest your money. Once you've managed to set aside some money, the next crucial step is to invest it wisely so it can grow over time. Typical savings accounts offer very low interest rates, which means your cash could lose purchasing power due to inflation. To combat this, the most important investing principle is diversification. This means spreading your money across various types of investments to minimize risk. The idea is to have a mix of investments because they perform differently in various market conditions. For instance, bonds might yield good returns when the stock market is down. Similarly, if one stock is underperforming, another might be doing exceptionally well. Diversifying your investments helps to balance potential losses with gains, ensuring more stable growth of your wealth. Mutual funds offer a convenient way to achieve diversification since they invest in a wide range of securities. To enhance your diversification even further, consider investing in both stock funds and bond funds, or even multiple stock and bond funds instead of sticking to just one type. This approach spreads your risk across different asset classes, which can help stabilize your returns over time. But keep in mind that the younger you are, the more risk you can afford to take. With more years ahead of you, you have a longer time horizon to recover from any potential losses, allowing you to take advantage of higher risk, higher reward investment opportunities. Investments come in various forms, each with its own level of risk and potential return. Generally, safer investments tend to offer lower returns, while riskier ones have the potential for higher gains. If you're not already familiar with the different types of investments, it's definitely worth taking some time to learn about them. While there are many exotic investment options out there, most people start with the basics: stocks, bonds, and mutual funds. Stocks represent shares of ownership in a corporation. When you purchase stock, you own a small part of that company and can benefit from any increase in its share price and any dividends it pays. Stocks are typically considered riskier than bonds, but the level of risk can vary greatly from one company to another. Bonds, on the other hand, are more like IOUs issued by a company or government. When you buy a bond, the issuer promises to repay your money plus interest after a specified period. Bonds are generally seen as less risky than stocks, but they also offer lower potential returns. However, not all bonds are created equal. Some are riskier than others, and bond rating agencies assign letter grades to reflect this risk. Mutual funds are collections of various securities, often including stocks, bonds, or a mix of both. When you purchase shares in a mutual fund, you essentially own a portion of this entire pool of investments. The risk associated with mutual funds can vary, depending on what types of securities they hold. Exchange-traded funds are quite similar to mutual funds in that each share represents a portfolio of different securities. However, ETFs are listed on exchanges and trade just like stocks. Some ETFs track major stock indexes like the S&P 500, while others focus on specific industry sectors or asset classes such as bonds and real estate. This makes ETFs a flexible and accessible option for many investors. Step number 6, management of debts. As you build wealth, you may find it beneficial to take on debt to fund various purchases or investments. You might use a credit card to earn points or rewards, apply for a mortgage for a home or second home, get a home equity loan for improvements, or take out an auto loan to buy a car. You might also consider a personal loan to start a business or invest in someone else's. Careful debt management is crucial. Too much debt can hinder your wealth-building efforts. Keep an eye on your debt-to-income ratio and ensure your debt payments fit within your budget. Aim to pay off high-interest debt, like credit card debt, as quickly as possible to avoid excessive interest charges. Be cautious with variable or adjustable interest rate products, such as adjustable rate mortgages or those with balloon payments, as economic changes or personal circumstances can make these debts difficult to manage. Thanks for watching. What financial topic are you most curious about and would like us to cover next? Let us know in the comments.